All right, so let's dive into it. This is going to be a good one. Hopefully not 3 hours like last week. Sorry about that, but it's important. You're going to continue to be drinking from a fire hose here, so let's get into executing. There are a lot of really great analysts out there. There's a lot of really great analysts out there. Let's be traders. Let's learn how to execute. We're going to talk about some really key terms today that we're going to talk about for the rest of our time together. Rhythm, acceptance, a trading time frame framework around developing value. And we're going to hit on risk from the basics, what you need to know, what you need to take care of. It doesn't have to be complicated. Trade management, a couple of tactics to apply there depending on the situation. And then we're going to talk about developing for the week. When you look up the definition, we talk about execution. You see it on Twitter a lot. You see people talk about it. What does it really mean? Well, the definition is the carrying out or putting into effect of a plan, order, or course of action. It's putting things into action. Something else has to have already existed in order for us to then go execute. We don't just execute out of thin air. And for us, we have narrative, we have risk reward, we have our bias, we have lines in the sand, and now we can go execute. But we have to have those things first. Why don't we just use narrative alone? Get that risk reward landscape and just put risk on and just let it go, right? You could, quite frankly, you could, but even then, at some point, you've got to figure out, I think, a process for clicking the button, hitting the hotkey. Like, when is the right time to do that? And so we get down to you're always going to have some type of execution, even if you didn't even use any lower time frames. I think that execution is the second biggest inhibitor of success. And that would be second to mental framework. And I think this is where you identify a lot of your mental framework issues, is around the attempt at flawless execution. This is where things show up. And quite frankly, the lower time frames you go, the more amplified deficiencies in mental framework show up. Fearless execution. This is something that popped into my head and quite frankly was inspiring as I wrote those words, and I hope it is to you as well. We want to get to the point of being aggressive but controlled, and utterly, if you want to be on my desk, I want you to be fearless. Let's get fired up here, okay? What do we have to be afraid of? Think about these times where you put on a trade, or you're about to put on a trade, or you're debating whether to put the trade on or not. That stress and tension, like, what is that? What's going on? Well, we talked a lot about that mental framework and things like that, but I am not some Zen master Buddha guy over here, okay? I am not. I'm your normal red-blooded American, male at that. Okay, that's a derogatory term. But I can tell you that you can get to a point. You may not always maintain it perfectly, but you can get to a point where you can actually trade from essentially a stress-free place. It's possible. Most people out there think that that's a fairy tale. And, you'll have some guys come on and they're good at trading or different things, or so we think. And they give this great sounding spiel about how these people, it's all bull crap. You're going to, have all these emotions and whatnot. And You are, but I'm serious in the fact that you can get anchored enough in the type of mental framework that I'm teaching you that you can no longer get really amped up and worried about and experiencing stress levels that are high as it relates to putting on a stupid one more trade. Okay. So you got to get there to get to that fearless execution. So that's just some introductory type stuff I wanted to hit you over the head with as we get going here. So here's really the first topic: rhythm. Context is king. The common mistake, I like to insert all these little warnings as we're about to talk about things, right? The common mistake that I see students have, just because of natural ways that humans kind of get into the more advanced things and the more fast moving things and forget about the slower, more boring, more beginner, quote unquote, stuff. So everything we're going to talk about today, the risk here is that you begin to lose the forest for the trees. You begin to lose focus on context because we're not talking about context. We're now diving into tactics and execution. So I just want to remind you, don't do that. It's going to be the natural tendency. Check yourself day in and day out and make sure that you're heeding that warning. So rhythm. What is rhythm? I mean, you can think of rhythm musically. That's kind of how I tend to often think about it. But not in terms of a precise, maybe metronome that we think of in terms of rhythm, right? I used to play the drums. I was the section leader of the drum line in high school. I tend to think of it, this rhythm, more of an inhale that requires an exhale, that requires the next inhale, or the crashing of the waves, right? The way it pulls out and pulls back in and things like that, right? It doesn't have to be perfectly rhythmic, but there is this two phases to things. And why is that? I think it's because of inventory, the way people get positioned, let's say long in a market, and then the inventory has to correct and adjust because of a concept I like to talk about. Not going to get too deep on it, but energy. If we start going higher in a market, let's say this is a short-term chart, okay? We're headed higher here. Why does it ebb and flow like that? Why does it inhale and exhale, right? Why is there a rhythm to the movement? Again, not precise rhythm, but just this two-way type thing. Energy and inventory, right? As people get long, and more people get long or whatever, once you're a buyer, you are now going forward a what? Once you've already bought, what are you? You're a seller. The very next thing you could do, and let's pretend you're not going to add to a position, right? You could buy more, I guess. But for the most part, once you're in your position long, you are now a potential seller. You are no longer a force of upward momentum in a market. You will work against upward momentum by either placing a sell limit order above the price or by selling the market and whacking a bid. So, these things markets just don't go in a straight line forever, right? We saw the S&P recently on a large time scale go way vertical. And why do you think it did this, right? We ran out of buyers, right? And that's a concept that we look at and whatnot. Called that top, by the way. I don't know if you guys saw that. So it's important. So let's look at a purely quantitative approach to rhythm. And before we really dive into it, remember that there's different ways to approach this quantitatively. Some people, and different things are good for different purposes or whatever, but some people will tell you to do a really long, over the past 2 years, study all the intraday rotations and find the median and the mode of those rotations. And that can be helpful in understanding the general nature of a market. It can be. But it's almost like our concepts around balance and imbalance. A market could have done this, and then this, and then this, and then this. So if I study this past 2 years of rotations, this is one up rotation, this is one down rotation, this is one up rotation, swings, right? Fractal point, whatever you want to call them. If I study all that, you know, yes, maybe there's more frequency of these smaller ones occurring, and the data will give me that. But there's a bunch of medium ones in there as well, and there's all kinds. So looking at just a basic distribution over 2 years of where the most frequently occurring rotation size, that's just a lot of data which happened over a long period of time and a lot of different volatility conditions. And so my approach is a little more dynamic, or maybe it's a more of a weighted moving average, if you will, of that type of studying. I like to look at more recent rotations and get a feel for the size of them. And that could be over the past few hours or something. So anyways, let's go to a chart. Let's check it out. All right, so here we are with our normal chart. We'll just make this one big. And we could mathematically show this ebb and flow of the rhythm of this market. And one way we might do that is by putting on what's called a zigzag indicator. I've got it ready to go here. So you see how it connects these points. The math here, if you want to know, is look for price that moves at least 50 cents away from a swing low or a swing high. Okay, so that's just the minimum fluctuation. But once you've met that minimum fluctuation, I want to see a 5-bar reversal. A 5-bar reversal is quite simply for a high. The high of this bar is higher than the highs of the 2 bars that preceded it and 2 bars that follow it. They don't have to be lower. It could be like that, but they're both lower. All 4 of those bars are lower. The highs of those bars are lower than the high of the middle bar. That creates a top that it's going to leave. As long as we've gone up 50 cents and that we create that pattern, it's going to leave it set in stone permanently. That's a swing high, and then we'll see what happens from there. Once we rotate down 50 cents from there, it makes sure that that stays the high, and then we'll be looking for the next low, you know, that type thing. So now, those of you who are newer to trading, don't think you can slap this indicator on, and as soon as this turns red, that's a place to short. As soon as this turns blue, that's a place. This thing, like I said, look, you have to have 2 bars after it, and you have to go 50 cents away from it to make sure that that stays there permanently. So this is a hindsight tool. This is not a trading tool. This is a tool for your eyeballs to get used to seeing rhythm. Some people find it helpful at the beginning of NADRO stages to kind of, what are we doing here? We're kind of smoothing out some noise, right? We're kind of averaging out some of the rotations. And so what I have down here in the bottom pane is a shorter term rhythm. We make a swing low, which was here, and then we make a swing high, which was here, and then we make another swing low here, swing high, swing low, swing high, right? So in this bottom pane, you can see kind of what we might refer to as short-term rhythm. And on the top pane here, we might see something that we could refer to as medium-term rhythm. You have multiple rotations that occur within short-term rotations that occur within medium-term rhythm. Again, don't get too bogged down in this as like, okay, what's the precision about what he's doing here, whatever. I'm trying to tell you to see markets rather than a candlestick that goes up and then maybe bearish engulfing or something and getting so granular, whether there's a wick here or not. I'm trying to get you to zoom the heck out and see markets like this. Okay. And see markets like this. Ebb and flow, rhythm. Just because a market does a little bit of down and a little bit of up doesn't necessarily change the fact that we can say, okay, generally that was up, generally this is down. Both of these studies are zigzag indicators, and we're going to be sharing the chart book with you and all that good stuff. But this is just a zigzag indicator that we've gone in, and that's not messy. And we have gone to the subgraph section and we have turned on to show the zigzag oscillator. We've made sure that it's in pane 2, and then we've pretty much ignored everything else and turned off any kind of text things over here. Back to the slide deck here. Ultimately, what are we going to use any of that for is that I want you to time your entries, right? That's kind of what we're talking about today, is timing and executing trades. And so I want you to be aware of this concept of rhythm, the ebb and the flow. And to get even more basic with you, this is going to look silly, but this is a very important concept for some folks. If you're going to get long, right? I want that long to occur here. I want that long to occur here. We're going to talk more about that. Now, I showed you the zigzag tool, which is mathematical. It's quantitative. Ultimately, do I use it? No, I don't. Do I think it's a good set of training wheels to start to help you see things? Yes. Ultimately, though, the human mind is tremendously powerful. And once you learn the concept of kind of averaging out the noise and seeing that overall ebb and flow, both on the short term and maybe what we call the medium term, it's in seeing those simultaneously, it's the human mind is really impeccable at doing a good job of that. What does it mean to be in rhythm? I'm going to ask of you guys that you're in rhythm. When you put an entry on, when you get into a position, I'm going to ask that you're in rhythm, please. I'm going to call you out. If you were, mentoring with me, I'm going to say you're out of rhythm. What are you doing? Now, does that mean that all your trades work and that they're perfect? No, it doesn't. But how can we be in rhythm per our standards here? It's going to require two things. Once you have a read on the general rhythm of the market, right? Is the market like this? Is the market like this? Right? Just a general sense of the volatility and the rotation sizes you're seeing. Lord knows the past week or so, we've had to evolve in that sense, right? Volatility goes through the roof. I mean, I just showed you on this screen, there was a $2 down move, followed by a 60-cent up move, followed by a $1 down move, followed by 70 cents up, followed by $1.50 down. That's not normal crude trading conditions, right? That last market was crude oil we were looking at. You got to adapt to that type of volatility. So how can we be in rhythm? What is going to be required of us? Number one, we have to have enough of a counter rotation. A counter rotation is counter to the direction we're looking to trade. So if you're looking to get long and the current rhythm is this, well, guess what? I'm going to need to see a decent sized down leg. Look, nothing's happened yet. We're not getting into a trade. I need to see enough of a pullback. Sound familiar? We tried to start training you guys on that subconsciously with the 4-bar pullbacks. It's just a silly little way to start training you to see enough of a pullback, not a 1-bar pullback and then we're getting long. That doesn't work out a lot unless you're just trading a choppy area. look for a decent pullback. We're no longer going to look for sequential Heikin-Ashi bars. Not at all. We're going to smooth out noise, and we're going to look at the real rhythm and rotations and start to get your skill set up on seeing that. It's going to take time, takes experience, but it's a very powerful thing. So number one, we need to see enough of a counter rotation. Number two, the entry, that trade fill, when you show me your fills for the day, it needs to be at the start of a turn in momentum, a shift in momentum. So as we're drifting down here, back to our drawing example, okay, we've recognized number one's taken care of. We got a decent move down. It could be this far. It could be this far. It could be this far. We don't know where it's going to turn. But at a certain point, we say, okay, it's gone far enough to have enough of a counter rotation. And now wherever we get something like a Heikin-Ashi shift, now, like maybe here, that is where the entry needs to be, right? So we enter with enough of a counter rotation and the turning points. We don't get in long here, right? That would be considered late. We don't get in long here. That would be considered early. That's not enough of a counter rotation. This is too late following the shift in momentum. It's kind of like the bears and the Goldilocks with the porridge. We need it to be just right. It really is that easy. This is not a rocket science concept. What's the general ebb and flow? Did we get enough of a pullback? Now, has there been a shift in momentum? Some of you are like, oh my goodness, maybe rolling your eyes. I don't know what the perception is, but I can tell you that this is going to be very helpful to a lot of people. Now, one thing that's really important, the last point here, what if the rhythm is like this and we come down and we get the turn and you get long and it does this? Were you out of rhythm? No, you were not. You had enough of a counter rotation. You got in at a momentum shift. It's regardless of the outcome, okay? So this was a nice trade in rhythm. Whether it was a nice trade overall, we'd need more information there around narrative and all that good stuff. Rhythm, short-term versus medium-term. Remember, we on that chart we were looking at, you could see both, right? You have a short-term rhythm, and you have a medium-term rhythm. This has one up leg and one down leg on the medium-term rhythm, and it has 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 or 10 up legs and down legs on the shorter-term rhythm. You can see both on the same chart. One thing about times where, like a lot of time, if markets were trading perfectly, we could just trade the short-term rhythm all the time and not worry about a whole lot. The thing is, though, is that markets will settle into, it might look like this, and then all of a sudden we get a move that looks like this. So we're still aware that things are looking pretty symmetrical here, right? By smoothing things out in terms of rhythm. But when we see more complex pullbacks like I'm describing here, multiple legs pulling back in a row sequentially, shifting to that more medium-term rhythm is a really, really key skill set. Like we had the webinar on Saturday. You get long here, you get stopped out, you get long here, you get stopped out. Like, are you going to keep trying it 3, 4, 5, 6 times? No. We're going to shift to more of a medium-term rhythm. We're going to look for something to substantially change about. We're going to ask that market to give us more of a shift in momentum rather than all these tiny single Heikin-Ashi bar changes, right? Just short-term momentum shifts. We're going to ask that market to now give us more momentum shift. And we will talk more about that. Okay. So rhythm, the ebb and the flow, don't overcomplicate it, but don't forget it. And the more advanced you get at this, the more you'll be able to incorporate what we kind of call the medium-term rhythm to help you out in situations like I just described. In terms of price action, there's really two patterns that I look for personally that I teach people about. And again, they're not rocket science. In fact, we won't be covering rocket science at all today. We will keep it simple and we will keep it robust and effective. One is a flag pattern. And what, most of you know what a flag pattern is, right? You have a move up, let's say, and then you have something like what I just drew, where the price action slows down. It's more of a complex grinding. That's the flag. That's the technical kind of pattern there. It looks kind of like a flag flapping in the wind, right? And that's done, like I said, when the flag breaks. Why do I like those? And why are they mostly about the angle? If we did this and then we did this, that's not a flag because the angle is too steep on the pullback. Flags to me, I'm all about identifying strength and trying to go with that, identifying weakness and trying to go against that in terms of trading. So to me, a flag is a very labored, difficult, weak, non-aggressive move while the bears are mostly in control here. This is a bull flag, right? I could draw the opposite, right? We go down steeply, and then the buyers are really weak. They can't lift it very fast, right? We would look for this to break and give us that. So that would be a bear flag. And again, it's about the angle. See the angle here relative, not to get too sciencey on you or whatever, but I think you understand. This is a 90-degree angle, right? And let's look at a bear flag. If it's like this, well, that's too steep of an angle, right? I don't know what that would be, 15 degrees. Even one like this is not great at kind of 45, but the weaker it is, the better. So this one is really nice. They can't get totally flat. That's just a consolidation. That's no longer a flag. It has to have a little bit of an angle to it. And really, it's a relativity thing too, not just like go measure your angles, guys. Just look at the movement, and then all of a sudden, it will stand out like a sore thumb compared to what you've been seeing. So how about we look at a real one? What do you say? Right? There's a couple examples of them on here, really. The one I wanted to point out to you was the one that made sense with a structural area, which was this one. But this could be construed as a small bull flag, actually, once we broke above the area. Is the exact same level from the prior session. It did the exact same thing. I believe this was crude oil. Doesn't matter the market though. We broke back into this structural area. And then we got really flaggy, as I call it. Right? We break down. The sellers tell us they're in control. Contextual shift. We're stalking return pullback. And the buyers are pretty weak here. They just grind, just barely moving it higher. Finally, we get the tag right there. And that's the break we were looking for. We're not going to label specific entries right now, but there's multiple ways of approaching it. You can continue to be really aggressive trying to time some of these. You can wait for an actual reference to get tagged like we got there and then be aggressive. Or you can get in later at times there. Now, speaking of getting in later, right, that seems a bit out of rhythm, especially if you stay focused on the short-term rhythm. So if we did short-term rhythm, let's keep it real short-term, right? All these rotations. Well, you know, only the good times to get into shorts would be there and there and there, right? Right at those short-term turning points. But we might purposely trade out of rhythm because guess what? This got really choppy here, and you get stopped out and you get stopped out again. You get stopped out again. You need to recognize where we start to form a flaggy type pattern. And then you need to be okay sacrificing that short-term rhythm a little bit for what? More of a medium-term rhythm. What might that look like on here? Well, we could go down, and then this is a kind of a symmetrical move, and then there, right? So you are getting in late in short-term rhythm by design whenever you get in at the proper time with more of a medium-term rhythm. Another time this happens is a law 10 compression, right? We're compressing into an area and all of a sudden it breaks and we're getting in. Well, you know, by design, we're not in from right there. So that's out of short-term rhythm. We don't always take trades in short-term rhythm, but we usually do. Rhythm, if we trade in rhythm, it gives us our best chance of at least getting that initial rotation, that ebb and that flow in our favor. That allows us to maybe take some partial profits, to at least see what the tape looks like as it begins to go in our favor. All those kind of things that are really important for trading well. Not only that, but it allows us to not just trade off narrative and to drop to kind of what we're calling our trading time frame, which is a lower time frame than narrative, and maximize risk reward. And we're going to talk all about that because we're going to use our stop placement with this trading time frame with rhythm. So now all of a sudden, instead of 1-to-1 on, you know, a big narrative type chart, you're pushing 5-to-1 because you were able to time your trade on a lower time frame better. There's trade-offs to that. Win percent is going to drop, but risk reward is greatly boosted. So if we do use rhythm, it also gives us that really clear out. And guys, putting your stop beyond a swing or whatever, it's not a sucker stop. I mean, it is and it isn't. But I think that you can accept, hey, you want to call it a sucker stop, whatever. My timing's really good. And if that wasn't the low, I want to be out for now until I decide to or my process tells me to put risk on again. So you can call it a sucker stop if you want. And I know plenty of times where my stop gets run because other people had their stops there too. That's part of the game here. And that's why we talk about excess and things like that, because that's going to get you a little bit past the sucker game. You've already seen some stops cleared. You've already seen excess created and an auction that's likely at least showing indications that it's completed in a certain direction, that low is secured, and you begin to look for trades the other way. So acceptance. What in the world is acceptance? We use that term with some of our laws of market dynamics. Let's get specific on it. And this was something that we talked about that I told you guys. You had asked some questions in the Q&A, and I said, we're getting to it. Getting chopped up sucks. It's one of the banes of the existence of a trader, getting chopped up. Any kind of momentum-based trader, it starts to go, and you place a bet that says it's going to keep going, and then it reverts. And you say, well, that failed. It's going to go the other way. And then, you know, it fails, and, you know, above and below a reference, your line in the sand, whatever the case may be, it's terrible. You lose money that way. Acceptance is really the intersection. It's going to draw upon rhythm, but it's really the intersection of context and our trading time frame. It's going to help us avoid getting chopped up. We're going to be slower to change what we call our current condition than we normally would be for like a basic trader. This is really key here. It doesn't matter if we ultimately get long or short, above or below a reference. What matters as to whether we should be still looking to get long or changing our mind and maybe looking to get shorts is what the acceptance picture is. That's a key concept. You've got a reference, and most people are like, well, you know, it's above, let's get long, right? Oh, it's below, let's get short. And we're going to use a whole different concept, combining what we learned about rhythm to determine relative to this level A, whether we should be looking to get long or short, depending on what price does around it. And then finally, never forget areas, not lines. Anytime I draw a line on a chart, anytime you have a composite value area high, that is not 347 and 75, right? Like, or whatever market that might be. It is an area from 349.50 down to 346.25. You know, I don't know. It's an area. Treated as such. Always areas, not lines. How do we see acceptance, right? What the heck is acceptance? Acceptance is measuring what the current condition is based on price auctioning above enough or enough below the reference in question, whether that's a composite value high or whatever the case may be. And how do we monitor where the acceptance picture changes? Two ways. One is quite simply how far, right? Price acceptance or distance, right? On the y-axis, the vertical up and down axis. So in this case here, price, let's say at this point in time, has gone far enough above this reference in question to say we have accepted above XYZ reference. During this section down here, we could say price has gone far enough below distance-wise, price-wise, y-axis-wise, to say that we are accepted below. And how far is far enough? The answer is roughly 50% of your read on the current rhythm. And that's really important. We could have a reference here, and the rhythm could be like this. And we could have gone this far above the reference. Have we accepted above this level? Not even close. The answer is no, because, you know, if this is the normal rhythm, well, you know, 50% of all that is roughly this big if you average out all those moves. And so, no, we have not gone that far above the level. Now, if you take that same picture there, we'll just erase a few things. And we now do like an example B, but using the exact same level. And we say the rhythm was this. And we move the exact height above the level that we did before, but this is the rhythm. We have now successfully accepted above the level. Acceptance only exists above or below at any given time. It can't be both, even when you're crisscrossing a level, which we will talk about. The other way that we might achieve acceptance is via enough time. And I'll go ahead and tell you, it's not necessarily time, right? It's essentially time, and it could very well be time, but it's not necessarily time because, for example, I might be using a volume chart, and it may not have actually been that much time that marked, but enough volume traded above there to give me a number of bars on the x-axis. And so I'm going to call it time acceptance. So what does that look like, right? We got a certain rhythm, and then maybe it's not, you know, enough through it, but then all of a sudden I'm going to draw them bar by bar now. It really starts to maybe form a flaggy type pattern or something. And so think about it. This average rhythm here on the y-axis was about this tall, right? So we didn't go quite that tall above the reference, did we? But what if we rotated this bad boy down on its side like this? Well, guess what? Now we're pretty close to that. Now we're quite, well, in fact, we're over 50%, right? It's a decent rotation, but you've just got to think of the distance. That's why I keep using this term distance. Distance can be this direction, distance can be this direction, or combination. But we measure from the start to the end, like you had a measuring tape almost, no matter which direction it goes. And so that's how we get a time acceptance hold. When we have acceptance above a level, we're bullish against the level. When we have acceptance below a level, we're bearish against the level. The area, not the line, right? Here's some time acceptance occurring in real life, right? Got a pretty wide rhythm here if we look at it from this perspective. So we didn't get enough distance through here, this level that is. But we got down here and we held 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 and we held. Rhythm starts at the beginning of time when the markets first began. That's when rhythm starts. Rhythm starts anytime you can look at a chart and look at some recent rotations. It doesn't matter where it starts. You want to look at the current regime of rhythm to get what I call that overall, what's the overall rhythm, right? That's just saying, let me look at the past several hours of data for me as a shorter term intraday trader. But you just look at a big, long, widescreen bar chart of whatever your time frame is and get a sense for what does that look like? What is that average kind of rotation that you're seeing for the current volatility? And that's your read on general rhythm. And then you use that to help determine the acceptance picture. Now, someone had asked about, well, what about when you're above or below a level? Do you just, does it weaken it? What's going on? If you're unclear on the acceptance picture, keep going left, keep backing up and find the most recent read that was absolutely clear. So over here during this section of the chart, we're above it, and then we're about below it by the same amount, and we're below it by this amount, and then we're above it by that amount, right? It's just absolutely above and below. So if you're down there in the trees, you're thinking, what the heck? This is so messy. This is maddening. We're above the level, we're below the level. I don't know where the acceptance picture is. Fine. You think a level's never going to be messy? You think we're never going to crisscross a level? Think again. but we need to keep backing up, backing up, backing up until we can find where the acceptance picture was clear. Obviously, what's the answer here, above or below? Sorry to make you type that. It's so easy. It's above, right? That's the last place it's clear. So it's kind of like the judicial system or whatever, right? Like acceptance persists until proven changed, something like that. You need to see the acceptance picture clearly change. Just because it gets messy, all this movement is still generally above the reference. And looking left to go find out, okay, it was really clear here, and now it's become unclear recently. We'll stay with what was clear. It's a very, very helpful best practice. So that's rhythm and acceptance. We use them together. If we got a situation where we've got a 3-day composite, and now we're beginning to look at short-term price action around those inflections, and you're thinking, do we have a breakout pullback? Where does it occur, right? Is it here? No, not yet, right? We don't have time acceptance. We don't have price distance acceptance. Not the time to get long. Okay, we didn't get time acceptance there. Oh, you know what? That's enough. That's good. Because the rhythm I'm seeing here is that. And so that's kind of, an average of this. And that's pretty nice. We've gotten just over 50% above there. I'm feeling pretty good about that. I'm going to begin stalking a pullback to get long if I can, as long as this general area, not line, can hold price and I can see some kind of momentum shift after enough of a counter rotation. Rhythm and acceptance relative to a structural line in the sand and potential, in this case, breakout pullback trade. Developing value, right? Developing value is one of the key NADRO components. It's, as are acceptance and rhythm, but quite frankly, you might have some questions around acceptance and rhythm this week. We might cover some stuff in the Q&A on Friday. You guys might get some great discussions going in the room as to whether this was acceptance here or not, what your read on the rhythm was, all those kind of things. But I'll go ahead and let you know that once you may have already had it, but once the light bulb moment clicks with those things, they're pretty rudimentary. Rhythm is more complicated. Acceptance becomes something that we almost don't even talk about because it's just kind of a way of life. We see the acceptance picture and we do what we need to do based on that. And it's very easy. Rhythm can get a little more complex as it evolves, as volatility expands and contracts, as we use medium-term rhythm compared to the short-term rhythm and where appropriately. And it's a little bit more complex, but rhythm is still fairly basic as well. And your eyeballs will treat you right there once you learn to see markets in that way. You may have noticed all the charts that you see from me. They're not these pretty big, wide colored candlesticks. I prefer the way those charts look, but those charts mislead me. They're too granular. They get me sucked into the information bar to bar, as opposed to seeing markets from a perspective of overall rhythm and smoothing out a lot of the noise and just seeing that ebb and that flow rather than, oh, this bar is higher than the last one. Oh, that's a little wick here or there, or oh, that's engulfing here or there. Nope. I can rise above all that noise, if you will, and I can see things from a more robust perspective relative to the auction that's unfolding and condition changes and things like that really matter. Other stuff doesn't matter that much, guys. Rotations themselves, they don't really mean anything. It's just a natural energy transfer and inventory ebbing and flowing throughout a market. Most of it's pretty darn random. The only ones that matter are where there's an actual acceptance shift, and you need to know the rhythm to know where the acceptance shift makes sense and where you can identify it. And so now we're getting to developing value. We're going to talk a lot more about really accessing the trade. We have a trade idea from narrative. That's underlined for a reason. The trade ideas come from narrative. LMDs, which give us bias, line in the sand, likely destinations. That's where trade ideas come from. I haven't stressed that enough in the past, I think, when I taught a lot of this stuff. And people learned what they're about to learn next around developing value and whatnot. And now they think that they can just trade off of it. We don't just trade off developing value. That's pretty much a losing proposition. So we get these trade ideas, and now you're starting to say, okay, I could time my trades with rhythm and look at where the acceptance picture changes, and then again use rhythm to time those with the momentum shift after decent pullbacks. I get it. And you're right. We could end the course right now. I really believe it. We could end the course right now, and you could go trade market profile, volume profile with the understanding of LMDs and look for where there's balance. And you could look at where the acceptance picture changes. And if you could work on timing your trades with rhythm, I genuinely believe that you could become CPT just with that information, and then a ton of hard work, which no matter what I tell you, that it's going to take that. I really believe that. And here we have a student, commenting. They've been through this stuff before. They get it. And sure enough, they focus too much on what I'm about to teach you, which is going to seem pretty cool. And they forget to put narrative first, right? I've been warning you guys since the first or second slide, right? Don't lose the forest for the trees. So how can we access these trade ideas? How can we do it responsibly, smartly? Where does it make sense on our trading time frame to begin to put these trades on once the acceptance picture is in our favor? Do we just trade any and every pullback? Like, is there anything better that we can apply? And the answer is yes, we can. We're going to loosely apply a lot of the exact same principles, quite frankly, that you already learned from multiple things I've told you. We're just going to kind of now do it on a lower time frame, and it's going to be really loose. It's not going to be overly precise, but there's just going to be some general ways that we can access trades that make sense. So we're talking about developing value here. Well, you have a day where you have a profile, and here's its value area, and that's at 4 p.m. Eastern. Well, did that value exist when we opened at 9:30? No, right? We made the first tick of the market. We didn't have value here and here. So maybe the market sold off real sharply in the morning. Maybe it bounced a little bit and then started to kind of recover and trade in this zone. Well, guess what? The profile or any other tool you use to measure value, it's going to give you a reading of what value area high and value area low is at that time. Might look something like this. And then maybe we keep, ranging a bit or something like that. And then maybe value starts to look like this. And then we trade higher or, whatever. And then value looks like this. Comes up a little bit. This one also comes up. I don't know, right? And then sure enough, look, we're there. The session closes, right? Let's just pretend that's the close. And you have your developing value becomes your existing value, which we're going to call prior value the next day, right? So it develops throughout the session, and we're going to use it. Now, there are multiple ways to measure value. I can think of 3, and they're all based around kind of this idea of the distribution and standard deviation or variance and whatnot from a mean, the point of control, the most traded price. We can do it with market profile. We can do the same thing with volume profile. Give it some more notches. And we can also use volume weighted average price, which has, it's just a single value that evolves over time or is static once it's all said and done. And then we can look at standard deviations or variance from that quote unquote point of control and have a sense of value high and value low as it evolves. You can all go look up volume weighted average price. The math's pretty simple. How much volume occurred at each price level. Therefore, what's the weighted average price where all the trading occurred. So if you trade 100 contracts up high and only 4 contracts down low during the session, well, then your volume weighted average price is going to be skewed higher than it is. Like, it's not going to be right in between those two because it's weighted by how much volume was done at whatever prices. So VWAP is the same concept as a market profile point of control or a volume profile VPOC. And then using standard deviations or variance from that mean is how we will identify the value area. Now, before we get to the charts, there are 2 main ways I'm going to go ahead and tell you to access the trade using developing value. We can fade an extreme of our trading time frame, developing value, or we can go with an imbalance. You guys already understand the concept of imbalance. You also understand, rotational balanced behavior. You understand both. So we're simply going to use a developing value intraday to apply many of the same exact concepts that we have with our LMDs and our CVAs and all that good stuff. It's just adding a different dimension in terms of time frame and a little more fluid of a way of viewing it. So let's go to a clean chart here. And actually, let's hide our levels just to make it real nice and clean. We'll keep our time range on here so you can see. Now, one thing that's very important about developing value, don't be the person who asks in the room on Thursday, hey, why is my developing value different than everyone else? Well, it's because your session time starts at midnight, because that's kind of what some platforms think makes sense. That's where the day changes, right? Well, guess what? Midnight is nothing in regard to the trading day. Midnight has nothing to do with anybody. It's midnight at different times all over the world. No one cares where midnight Eastern is, or midnight Central, or where, Chicago, New York, whatever. What people care about is where the exchange resets and stops trading for the day. And a lot of day traders like us get flat before that and things like that. So that occurs at 6 p.m. Eastern is when we open back up for trade. So if we go to the trade settings for this chart, you'll see 1800, 6 p.m. Eastern, up until 1759, which is unnecessary, but that's just to make sure everything's covered. So instead of from midnight until 11:59 p.m., before the stroke of midnight, make sure that it's from 6 p.m. or whatever your time zone is set to, so that it's the CME, if you're trading a CME product, whatever exchange it is, the reset time. All exchanges reset every day. So that's important because we want to begin to measure value as it develops once the session reopens. So we can go to analysis, studies, and there's a built-in one here in Sierra chart, volume weighted average price. I would say that I have full confidence in it at this point in time to do a great job. I like a custom study. It's called ECI VWAP. All you do is go to your user contributed studies in this list and just start typing in EC, and it'll get you here. There's several of them, but just the basic one, ECI VWAP version 1.4. So we can add that to our chart. We can go to its settings. I guess just to show you what it kind of looks like here, it's a whole bunch of junk on it. Extend all these things. That's from the prior period. No, none of it. Okay. And then if we go to our subgraphs here and choose all the different things, as you can see, it's set to be in half standard deviation increments. So we have this middle line here, which is VWAP, as you can see. These dotted lines above and below are the 0.5 standard deviation, and the full shaded region, the way I have it drawn, is the full plus and minus 1, and then above that, the 1.5 plus and minus, and then the 2 plus and minus. I don't care about the 0.5. So the 0.5 is top and bottom band 1. Remember, we're going in half standard deviation increments. So the top and bottom band 1 outside of VWAP are that 0.5. I'm going to set both of those to ignore because I don't need them. I don't use them. There, they're gone. And that's pretty much my VWAP chart. I mean, we could essentially not do anything more. I typically turn these things off. Keep things clean. And so now we're looking at that. And immediately what might jump off the page at us is, oh, Friday we trended down, right? Versus what's happened overnight and into this holiday, Labor Day, we were balanced. So let's get you a few labels on here and understand some terms and things that we call everything. The shaded region here is our DVA. Make sure that this is understood to be all this. This is developing value area high. This is developing value area low. This is VWAP. This would be, and the same nomenclature for the 1.5, this would be the +2. This would be the -2, right? Plus 1.5. Pretty simple. It's developing value area, and then we have the 1.5 and the 2. We have VWAP, we have developing value high and developing value low. It's the same. It's, in a large degree, it's the same. We don't have 1.5s and 2s, but we have a point of control on a CVA. We have composite value high, composite value low. We just don't have those extra, upper 1.5s and 2s. But that's something we're going to add to this just to give us a loose framework to understand how much energy there is. This is a lot of energy here. This was a massive $2 sell-off. This was, other than like crazy news catalyst in Saudi Arabia, this is about as wild as crude moves. And we're pushing, beyond that second standard deviation during the most intense part of the move. Other times during more rotational behavior, as you can see, the second standard deviation might get touched. Looks like it happened twice. We don't count the very beginning. You could just ignore it because it's developing, right? Like, what is this, right? It doesn't exist yet. And then, okay, we can start to use it. So you have to let it evolve a little bit and open up and you know, give a decent reading, like a profile, right? What if you trade the first 2 ticks of the day in A period? Is that something you can use? No, it's not. You got to let it start to trade, and then maybe B period shows up, and then you start to get a sense of what's happening. Common sense. Yes, crude, S&P, any CME, and that includes NYMEX, you know, type product. The exchange reset is typically 1800. All that information is always going to be on the exchange websites. Go to contract specifications, just Google NASDAQ contract specifications. It's going to give you the hour, the session times, and things like that. Let's see here. So remember, there's 2 ways we can get into a trade. And I want to show you, just because I like to keep things as simple as possible at the very beginning. I just want to show you theoretically what I'm talking about. You probably already know. But, you know, if we are rotational, and here's our DVA, developing value high, developing value low. And then price is trading like this, right? As it does during a rotational period. We could shift to being imbalanced at any point in time. We never know when that's going to happen. But this is rotational. We were rotational the whole time. The trades, depending on narrative, depending on the trades that we're stalking, that we're going to use DVA to access, the trades might be anything where we could fade an extreme that makes sense with narrative. If we were bearish from this level up here, we would find a short here. We would find maybe 2 different shorts here on those momentum shifts. If we were bullish from this area, we might get long there. We might get long there. We might get long here. We might get long there. And we might be stalking to get long here. 2 ways of accessing a trade. 1, we fade extremes if we're rotational. That is, we're balancing within, for the most part, not perfectly, right? Obviously, we went outside of developing value here. We can probe outside, but as long as we keep coming back in, we are rotational, and our job is to fade extremes if narrative tells us there's opportunity that we need to be deploying that tactic. The other way we can use DVA to get into a trade is by going with an imbalance. So let's say that we had a breakout pullback and we're now bullish above this level. And DVA looks like this. And the price action looks like this, right? This is a place to look to get long. This is a place to look to get long. This is a place to look to get long. And these are pretty, you know, perfect looking, picture perfect examples, but this is theory. We were bullish because of narrative, because of the acceptance picture that changed here from rotational according to composite structure. We got the breakout. And so now, one way we could get long and access this trade, there's 2 ways we could do it. I'm just showing you one of them. The market got imbalanced intraday. We're trending higher. We're not able to accept anywhere back inside with any meaningful holds back inside that developing value area, where price is being rejected by that developing value area from outside. Therefore, we're what we call imbalanced up. And so we can continue to trade what we call imbalanced pullbacks, buying those pullbacks in and around the area of developing value as a general principle. Let's go back to the slides for a bit, and we will come back to real charts as well. Two ways to access the trade: fade extremes or go with an imbalance. This is on our trading time frame using developing value. Before we get to a lot more details, more warnings for you guys. These warnings are very, very important because I have a lot of experience teaching people these concepts, and I have a lot of experience seeing the roadblocks that people hit, the erroneous ways in which they try and use these tools. So these warnings are a ton of wisdom coming at you. That's what they are. It's me doing my best earnest job to help you avoid some pitfalls. Why are you paying this money? It's to shorten the learning curve. It's to learn something valuable. And that's why these warnings come at you. So developing value area is a loose framework. It is not a magic tool. You will often see it work to the tick. It will, like I said, open your eyes and allow you to see things that you previously may have thought impossible. Remember that little spiel at the beginning. DVA is going to be one of those things for you. The algos love it for sure. They use it. That's one of the reasons why it works so well. It's just most institutional and professional traders use VWAP. It's something the whole market's looking at. But it also, so it's a self-fulfilling prophecy, but at the same time, it follows the principles of AMT and whatnot, the way we use this. But anyways, has to be a loose guide. What do we mean by loose? Well, areas, not lines. Don't get too hung up on anything precise. Just in general, if it's pretty rotational, look to fade extremes. In general, if you're really bullish and it gets imbalanced, you can go with a general imbalance. Doesn't mean that the pullback has to pull perfectly back to developing value. It could pull deeper. It could pull shallower. Just use it as a general framework. And again, to beat the dead horse, developing value area does not create trades on its own. Context, narrative creates our bias in our trades. So it's still your job to use rhythm and get a read on momentum and structural areas to time your trades. We don't just, hey, look, you know, how many times have I seen this? How many times have you guys seen this in the community even? You know, price is imbalanced down, and it doesn't matter what may have happened or what the narrative might be or whether we've already hit a destination, and you see somebody get short right there just because they've been taught that that's technically what we call an imbalance pullback, and they just get absolutely run over. There was no shift in momentum. The trade didn't even make sense relative to narrative. Maybe we should have been bullish from this area, and they're taking this trade because DVA, quote unquote, you know, gave a shorter term setup, if you will, right? But they didn't use context. The real magic happens, as I was already kind of describing to you, is combining structural narrative with our trading time frame developing value area. So I'll give you another example of a breakout pullback of a CVA, except this one's going to be different. Remember last time we got imbalanced up. We went with those imbalanced moves. This time around, let's say we gapped up, and here's our developing value area. And let's draw price now. Price is here. Right? Are we rotational intraday on our trading time frame? Are we rotational? Are we imbalanced up? Are we imbalanced down? What are we intraday with our DVA? See, look at that. Some answers coming in, imbalanced up. That's context. Contextually, if we split these two into separate charts, here's DVA and price. It's clearly rotational. Here is CVA and price. It's clearly imbalanced up. The real magic here is we don't need, we're not looking for those two different time frame conditions to be the same. We know that we are bullish against composite value area high. You're going to see my daily market insight level have a nice green level from this area. And then we're rotational intraday, so my job is to fade extremes with developing value. So that means this was a long entry, this was a long entry, potential entries, right? This was a long entry. Those were the opportunities the market gave me to do what I need to do, which is access the narrative-driven trade using one of two ways to access that trade with developing value area on a lower time frame. What about these shorts, right? We could fade upper extremes, right? We're rotational. Can I short the upper extremes? Well, what would that person be doing? That person would be looking to trade purely based off of developing value and ignoring the fact that the narrative is bullish. Let's look at some real examples. One thing that's important is understanding you may have price, you may have a DVA, and you may have price that pushes an extreme, and we may consider this a point to look for a long, depending on narrative. But once we get an established imbalance, that is, counter rotations are being held outside of DVA. So this rotation comes up, maybe we're already long here because that nothing has happened yet to change us from perhaps the rotational state we've been in. But if we see this hold and the market does this, we are now in an established imbalance down in this case. VWAP is going to start to slope down. This is going to head down. There's a difference. So now you don't get long and you say, oh, Merritt, I was just fading a lower extreme. Well, no, we don't fade lower extremes when we have an established imbalance against us. I don't care how bullish you are. This is the basics. We can get more advanced down the road, but this is the basics. This is how I help people stop blowing up their accounts and losing unnecessarily on trend days. They had it in their mind that you're bullish, for whatever reason. So you don't fight imbalance down. How do you get involved, right? Maybe you don't. Well, guess what? If it never bounced and stopped being imbalanced down, you never would have made any money anyways, unless you're just scalping the tiniest of rotations. So let's look at this real example here on the right. We have a counter rotation where we get imbalanced down, and right here we get confirmation that we're not getting back inside developing value area, and so we are going full on imbalance down with DVA. Again, it still confirms it. So let's say our main line in the sand for the day was this general CVA here. By the way, this is a recent example. This may have been Friday or Thursday. I don't know when this was. If you really want to get long, and this is your main line in the sand, your best idea, I want to be long from here. You don't do it here. And I'm not just saying that because it blew through there and didn't work. You do it here once the market starts to go rotational with DVA. We now have not continued to hold outside of developing value, and the market starts to show us something that buyers and sellers are at least battling it out a bit more here, and we're going more rotational. So we're seeing these rotations inside of our developing value area. So this becomes a lower extreme to fade because now we're rotational, so we can fade lower extremes. So I don't care how good your CVA level is or what confluence you have or whatever. We don't just stick our necks out and just put a limit order in front of an imbalance against us. You wait until you get one of two conditions that allow you to get long. If you want to get long, there's two ways to do it. One, if it's a rotational DVA, you could get long at lower extremes. If we're imbalanced up, you can buy what we call imbalanced pullbacks. If we're imbalanced down, you don't get to do anything. If you're looking to bid long, if you're looking to get short based on narrative, how do we do that? Well, you could fade upper extremes during a rotational environment. You could go with imbalanced pullbacks during an imbalance down, and you can't do anything but wait for something to change if we're imbalanced up. Really, like you're going to love the trade locations of DVA. They can be pretty magical pretty frequently. But the professional way to say how DVA helps you, it actually avoids all the bad trades. And that doesn't sound as sexy. That's not as cool. But I'm telling you that that's the benefit of DVA, is to not get into some really dumb trades, right? Absolutely, it's a filter. That's exactly what it is. And yeah, David, it's yeah, we don't just get long because there's a CVA there. We wait until we get one of the two. If you're looking to get long because of that CVA, why would we be doing that? Oh, the acceptance picture. It's above the CVA. It's an overall breakout pullback, whatever the case may be. You can either not get long if you don't get any trades from DVA. That's going to happen. It's frustrating. It's going to happen. Or you can fade a lower extreme if it's rotational, or you can hop on board with an imbalance up if it's imbalanced up. All of those things relative to DVA. Losing trades. Someone asked about losing trades on the Q&A, and I've got more for you there. A situation where we would love to see that perfect imbalance, where it just does this, right? Markets aren't that precise. It doesn't always happen that way. So sometimes it pushes in really quite deeply, on the way from, let's say, a bearish destination to, in this case, the next likely destination. And, you might think, okay, this is an imbalanced pullback, and you'd be correct. You get long here once you get that, momentum shift, and it stops you out and then goes to the target. Well, boo-hoo. It's going to happen. More advanced traders begin to realize, oh, you know what? This market has gone here directly from here. It might actually need to pull back. This is an important reference, so we might get a different trade location there, but that's not a discussion for today. The point is that you're going to have losing trades, and one of the conditions in which we have more losing trades is where the market kind of can't decide. I call it a slow trend environment. It can't decide if it's going to be, see how this was just nicely imbalanced, really kind of perfection. And then it can't really decide. It's like we're imbalanced down. Oh no, we're rotational. Oh no, we're imbalanced down. You have some losing trades in those sequences at times. More losing trades. Let's talk about more. Frequent shifts where the market tries to go imbalanced or tries to go rotational and then just does the opposite. It doesn't follow through with that conditioned shift. So, you know, we try to go imbalanced down here on a micro type basis, and then you get a rotation, but then it stops you out. Okay, we're imbalanced up. Let's get long here, right? Oh, it just barely tries and then stops you out. We're imbalanced here, you know, going with this imbalanced pullback here, and it gives you a rotation and then stops you out. So the condition kind of shifting and not holding is where we tend to have some losing trades. Now, I'm sure some of you have been thinking like, do we only ever take picture perfect breakout pullbacks, and then as we go to that likely destination of that older CVA, like if we didn't get short from right here, there's just nothing left for us? No. We have continuation plays while a narrative is playing out, and DVA is going to help us do that, right? We have to sleep. We can't catch everything. Sometimes we just flat out miss something. Sometimes we get a breakout that just does this and then goes, and we never got that breakout pullback on a classic sense that we were looking for. DVA didn't give us the trade either, you know? It just wasn't given. It just kept going. Only the breakout traders got it. That's going to happen. But there's still, even though we missed that A+ best trade location, the narrative's still playing out. It's still happening, and we haven't hit a destination yet. So let's see if we can get on board. These are continuation plays, second chance entries, whatever you want to call it. Here's one of my DMI recaps. I said, you know, here in the open was a good place to get long. And then either one of these pullback areas right here were good places to get until what? We hit the area we had for our prep, and then the market turned from there and kind of went sideways. Now, here's the chart with you guys now getting to see behind the scenes of what that looks like. The initial entry at the open was this, where I'm fading a lower extreme after the market tried to go imbalance down, cleared out some stops, popped back into developing value, and now I'm saying it's rotational. This is a bullish line in the sand we're getting this reaction from. I'm going to take the trade from a lower extreme. A+. What about the continuation plays before we get to the target area? Oh, imbalanced pullbacks. This is just from recent DMI. I don't know what this day was, but it's one of the first kind of like real good continuation plays of an example I could go grab for you real quick. So, you know, this didn't have a structural area that we were trading from. It's in what I call open space. But the market has shown us it's reacted to our structural narrative trade location. And maybe we got into the position, maybe we didn't from there, doesn't matter. But now we can take advantage of some imbalanced pullbacks along the way until we get to our destination. And guess what? I hadn't even planned to say it, but what about this imbalanced pullback? Why do we not like this imbalanced pullback? New students only. I like the way Collins said it. You all nailed it. Everyone got it right. But I like Collins' answer the best there. Spectrum of opportunity. That's really what's going on here. Think in terms of those laws and where is good opportunity and where is not. So absolutely, because the destination was tagged, there is less opportunity. You're just going to keep forcing the issue. If we're going to keep, you know, you could exit here and then maybe DVA keeps going, and then maybe you get this trade. That's a better trade pretty much than those were, because now we got a fresh shift across the next area. Markets don't keep trending in the same direction forever, so you start to get a little leery as you keep trending and trending, but they don't just sit there and say, oh, it's just gone too far, it can't. No, trade what is. Good answers, guys. What do we have so far? So far, we have a way to prep and see the narrative so that we can come up with some hypos. We can now, as of today, monitor for acceptance relative to those key lines in the sand that our hypos generate for us, while being aware of the current rhythm, right? Leading us to see where we have breakout pullback or return pullback opportunities, or second chance type entries, continuation plays. If we have one of those opportunities setting up for us, we can then, and only then, use developing value on our trading time frame as a loose framework to either fade an extreme or go with an imbalance. If we're looking to get long because of the breakout pullback or whatever, we can fade a lower extreme or go with an imbalance up. If narrative has us looking for a return pullback short, we can fade an upper extreme of DVA or go with an imbalance down. And then ultimately we time that entry, being in rhythm, enough of a counter rotation, just that beginning shift in momentum that makes sense with DVA, that makes sense within narrative. Let's talk about risk and trade management. We're going to keep this pretty simple. It's not the priority. I know that trade management is important, and we're going to give you a great template to use, but risk is the ultimate filter. Nothing else trumps it. Even narrative, laws of market dynamics, none of that stuff, right? It's just a framework for identifying potential opportunity that there's no guarantees of anything working out in our favor. Risk is the overarching system or filter. It's the ultimate filter. I think futures traders should essentially keep risk consistent. I think there's other types of trading where you have like amazing opportunities and then just like kind of a feeler trade here or whatever. I think futures traders trading a similar basket of stocks, or of products, of contracts, day in and day out, we don't really have the best sense of, oh, this one's really going to work. It's got like, XYZ behind it. And then, oh, this one's not as good. So I think keeping risk consistent is important. I don't believe in like loading the boat from, and really sizing up and risking like, way too much on an individual entry. Keep it consistent. How do we size our trades? Number one, you start with a daily loss limit. That's going to just be like a financial thing for you, right? What's your portfolio like? Like what's your trading account? Figure out a daily loss limit that's comfortable. How many attempts do you then need to do what you do on a day in, day out basis? You take one trade a day? Do you need to be able to take 20 and lose on all 20 before you stop for the day? Probably not, right? 3, 4, 5, 6 is probably good for a lot of day trading futures traders. So we have a daily loss limit, and now we know how many attempts that we need. So we divide the daily loss limit by the number of attempts we need. That tells us the R value. That's a term we'll use a lot. R value is the dollar amount that you want to consistently risk per trade. And then how large should we trade? Well, divide the R value by how far away your stop is in, ticks times the tick value of the instrument you're trading. So let's say that we had a $1,500 daily loss limit. And let's say that we need 5 attempts today. We per 5 trades per day, we'd like to be able to stop out 5 times before we quit for the day and say we just don't have it today, right? So that means we need to risk what? Daily loss limit divided by the attempts. Our R value is going to equal $300. $300 times 5 attempts is the $1,500 max loss for the day. We want to risk $300 to find out if a trade's going to work or not. Let's say we're trading crude. Crude has a $10 per tick size. Let's say that our stop loss is 15 cents away. That's 15 ticks. So we want to risk $300. 15 ticks on a 1 lot is $150. Oh, we'll trade 2 lots. That's how you size a position. You don't have to, you're not going to be doing this much math. You know, you're going to learn, okay, for my R value, okay, you know, I know that if I can get something with an 8 tick stop, I'll trade 2 lots. But if it's a 10, 15, 16 tick stop, I trade 1 lot, you know, so you'll learn that and then you'll evolve over time as your daily loss limit gets bigger. That is the correct way to size a trade. You have to have a daily loss limit. You can't operate without a daily loss limit. That you won't be in the business very long if you don't. So we have our daily loss limit. We have our R value. What else might we need? Max number of attempts at a single narrative or thesis. That would be important. I think a lot of people thrive with kind of a 3 strikes and out rule. Some people less, right? Maybe 2. It depends on you and what you need. Some of these other rules. Not everyone has to have a max number of attempts on a single idea, but most people, it's a good idea. A give back rule, you know, that's a really good rule because you have the power to do so much psychological damage that can carry over into the next day. If you at some point had a really, really good day on Monday, it's your best day ever, okay? And then you ended up daily loss limit on Monday. You think you're coming in real squeaky clean with no baggage on Tuesday? That's hard. You'd have a great mental framework for that to happen. Absolutely. A market took something from you. You're showing up Tuesday bright and early to get it back. You got something to prove. You know, that's natural type stuff. Mental framework, awareness, making impulses go through a process which we're developing here, and market generated information, which we're teaching you how to see more objectively and clearly. That's got to happen or else you will destroy yourself, as all natural human traders do. So a give back rule is really nice. Let's say that, you know, your daily loss limit's 1,500. If you're up 3-4 grand on the day, you know, set a 50% give back rule. Once you cross the threshold of being up 4,000 for the day, you stop if it comes back down to only up 2,000 for the day. It just makes so much sense from a psychological capital perspective and just from a bottom line, you know, of your trading perspective. And then other rules that you need. Maybe you experience certain triggers, certain sequences of events, maybe 2 losers in a row, which trigger you and send you into screw process or, you know, whatever the case may be, or going into revenge type mode. Create rules, which are a risk rule. It may not have a dollar value on it, but trust me, it's going to be dollar value related at the end of the day or the end of the week or the month. You have to take a break if you have 2 losers in a row. Take 15 minutes, get some fresh air, come back and lock and load. Both the downside and the upside of trading, that is having losers and having winners, it should be dynamic. not static. Don't tell me you trade with a 2-point stop in ES and that's just what you do. Don't tell me you always take profits at 4 points in ES. That's just what you do. Markets are dynamic in terms of volatility, which means how many points they're moving, which you get a sense of with rhythm. Even DVA is volatility based. So we're going to talk about using those tools for trade management on things. Don't be static. Don't do that. NADRO, the way I trade it, the way I teach it, it's predominantly all in at the point of entry, and then we scale out we take partial profits along the way. So in order to do that, you obviously need more than one contract. So that's what's been great about the micros. People trading MES, MNQ, and trading 3 or 4 lots and getting experience with handling those multiple scale outs and quite frankly the emotional aid that scaling out can have as well on just being able to hold a core position and stuff. So it's been really nice to have that as a training tool and vehicle for people. So let's talk about stop placement. Let's talk about reentries. Let's talk about managing winning trades. But before we do that, just want to remind you, trade management can never, will never, could never possibly be perfect. We talked about this in mental framework. You come out early. Oh, well, that's the very time where it runs 1,000,000 points. Oh, that happened to me last time. So this time I'm going to hold the position. I've got it at the top of my journal here. Hold the position, man. And then it goes like halfway to your target and then runs all the way back and stops you out. And now you're like, what the heck? The market's out to get me. Okay. It's never going to be perfect. Now I'm going to show you based on narrative, based on the intraday condition, how to manage trades appropriately, because I think it aligns with the odds, the probabilities of what's happening. Spoiler alert, if you've got a fantastic narrative, leave more of a runner on. Anything less than that, leave less of a runner on, right? So it just makes simple sense, because our edge not only comes from the edges, but our edge comes from speaking the language of a market, identifying we're not just trading blind moving average crossovers here or buying when RSI is below 20. We're speaking the language. We can see things that other people can't. So we're going to adapt our trade management to suit what's happening. And that helps us incrementally improve our edge, because it will never be perfect, but we can just align things in our favor, align things in our favor, align things in our favor where it's appropriate. Apply the appropriate tactics. There's plenty of elite performances where you apply the appropriate tactic and you still get your butt beat. And trading is no different. So stop placement, where we put our stop, is really about what do you want to bet on? You want to bet on context being right overall? That's going to be a really, really wide stop. Do you want to bet on what I'm going to tell you to do? What I typically do is a shift in momentum. Okay, I know the context. I've identified a shift in momentum. I'm going to put the stop beyond that. If that shift in momentum doesn't hold, I'm wrong for now. Or, as I rarely do, but sometimes it's appropriate, this must, there's just barely any ticks that I will allow this thing to just tick up against me here. This is a momentum. I'm going to place a bet that the momentum persists now and does not falter. There's pros and cons to each of those. And I think there's certain times, if you really want to, get more advanced and get better over time, not right now, where each of those could be more appropriate. And you guys that have been around have seen me apply each of those 3 to varying degrees. How you see me do it 90% of the time, though, is the market trades up into an area where I'm interested in. and we get a momentum shift, Heikin-Ashi change. That's where my entry is, and my stop goes beyond the turn. In fact, let's draw it another way. It comes up into the area I'm interested in. I get the momentum shift. That's where I get short, and my stop goes beyond the turn. I didn't want you to think here that the stop was above this line for any reason. The stop is placed above the turning point on the lower time, on the trading time frame. I'm thinking areas, not lines anyways, in regard to the contextual line in the sand. The acceptance picture is telling me that I want to be getting short here, not whether or not I'm getting short above the line or short below the line. It's all coming together here. So I've been training you guys on seeing those turning points, shifts in momentum on a trading time frame, just like with the dummy system. Why do I like this? I love maximizing risk reward with a reasonable degree of wiggle room. That's kind of how I feel about it. You know, if I'm going to get into a turning point and I get short right here, and am I going to put my stop one tick above the tick that I got on in? Well, that's going to stop me out a whole lot, isn't it? Even if it just blips and goes. Am I going to put it 2 ticks above? No, I'm going to put it 8 ticks above, somewhere beyond where we got to a point in the auction process where the energy shifted, the energy that buyers had dissipated, the sellers begin to take control and get more aggressive. So to me, there's an incremental edge in doing that. And hopefully, as I mentioned to you, that's using rhythm, right? Hopefully, it at least rewards me with a decent counter rotation in which I might get some partial profits before I get stopped out. If it's going to be a stop out, a lot of times, if you time the trade really well, you might get a scale out before you have a stop out. And that's very helpful to smoothing out your equity curve. There's a downside to scaling out, but anyways, we'll talk more about that. So that's why I like it. It really maximizes risk reward, and it's a reasonable degree of a demand on the market to do something, right? Now, what's important about this approach that you understand right away is that, remember, context is not necessarily invalidated. Not at all. We can have our level, and we might come up into here, and I might get short right here, and I might get stopped out. And then it might do this, and I might get short right here. And it might work, who knows? It might not. But the point is that this stop out didn't affect anything about narrative. The acceptance picture didn't change, right? Medium-term rhythm, nothing changed. Even short-term rhythm didn't accept above the level. So I remained bearish. Nothing changed about my plans, my overall hypo, areas, not lines. And so I just continued to look for places where it made sense that I got momentum shifts, and I just kept executing the trade, embracing the randomness, embracing any short-term noise and wicks and stop outs and stop runs. If I got a stupid dummy stop, whatever, I don't care. I have a strategy with my narrative, and now I'm applying some tactics to get involved with it, and they don't all work. And I'm going to keep doing that. Hey, 3 strikes and out, we'll just bow out and say, you got me this time. Fine. You're going to get me more times. No problem. We talked about this on Saturday. I think it's a good idea for you guys to approach it the way I teach it here. But some people have a lot of trouble operating on some of these lower time frames that I do and having the tighter stops. They don't seem to get a lot of the timing principles exactly right, and they don't find a way to see that medium-term rhythm. If you're interested in this topic and hearing from people in our community on struggles and a lot of successes from people who have kind of conquered it, that webinar is recorded, and you can take a look at that in the recording section. But I think approach it this way first. If over time you're seeing narrative great and you're just getting stopped out too often, unable to participate. Now, we're all going to get stopped out, but we're going to talk about that later. But if you're not able to participate in the moves that you're seeing with enough frequency, widen those stops. Find a way of approaching stop placement and how loose you might be with that. Even it's going to sacrifice your risk reward. That's okay. The risk reward's still there, even on the narrative time frame. We're just amplifying risk reward with the lower time frame. So you got a lot of wiggle room left before you run out of risk reward. So there's no shame in that, but I think try it the way I teach it first, and then take it from there and develop your own methods as we'll talk about. That's one of the biggest things we do in advanced group mentoring is help people identify their niche and their strong suits and how they might approach trading for their business within the NADRO framework. You could widen out your time frame. That's one way to get wider stops. You could trade a 15-minute chart and put stops beyond those turning points, right? You're going to be getting in a little later. Your stop's going to be wider, but your win percent's going to go up. You know, the win percent could be better than mine is, but my risk reward's going to be better than yours. So it's all a trade-off. Now, we talked about getting stopped out, but still catching the move. Re-entering trades is not a thing some of you might do if you're gonna trade the way I do with momentum-based, like, you know, turning point stops, where the context isn't validated yet. It is not invalidated, right? We're stopping out, but the trade is still 100% valid. It's still a return pullback. Right? We get short right there, and we get stopped out, and we get back in. Right? Maybe that works. That first trade was great. There's no problem with that. It's close enough to the area. Got a momentum shift. Looks like it's in rhythm here. Fine. Right? That's going to happen to me. That's going to especially happen to you guys at the beginning. It's going to happen to all of us, and you have to get back in if context isn't validated. Now, there has to be a limit to that. Remember, 3 strikes and out, things like that. But we can't avoid the noise. It's just too much of it. It's too random. So I've gotten into overlanding this year. Got a truck rigged out where I kind of, you know, survive out of it, go out in the middle of nowhere, me, the wife, and the dog, and you know, you're self-sufficient and you're traveling and seeing beautiful things, and you're out in nature and you're sleeping and eating and living out there. One of the things that happened on a trip recently was, well, you know, you plan it all out. You get the maps, you got all these like GPS systems and all these things, because it's not paved roads, right? You're off-roading, and so it's a lot more mapping and planning that needs to be done than just, hey Google, you know, take me somewhere. Well, there was like a sinkhole or something, right? Road closed. We're trying to get to the destination. We know exactly the campsite we're trying to get to. We've researched it. And you run across, you know, oh man, randomness, sinkhole, night before, wash out from a storm. Is the trip over? Do we go home? No, there's probably another opportunity, and we'll look for that opportunity. There might not be, but more times than not, there's a different way of getting there, a different way of accessing the campsite. Same deal here. Narrative is our roadmap. DVA and these other tools are just the engine and the wheels and everything, you know, getting the job done. And sometimes we have to take some detours and some turns, and that's part of it. Part of it. It's not frustrating. It's not bad. It's part of it. It's what we're doing. So it's required if you're gonna trade with shorter term stops. Now, scratching out. Just don't do this at first, okay? So many issues that I've seen over the years with people saying, you know, I can scratch out whenever I want. They're hurting themselves. You're not as good as you think you are. You don't have a solid enough mental framework to stay objective. And so the natural human trader wreaks a bit of havoc on your P&L because you're getting emotional and impulsive about, oh, I'm afraid and I'm out of the trade. Doesn't look good. I'm out. Well, guess what? You're not good enough to know what's good or what's not. You haven't learned to see what information is truly threatening to the position or what just feels threatening to you and your success as a trader and your mentality, right? So we don't scratch. Eventually, it could become a really powerful skill. But at the beginning, you need to earn the right to do that. You need to be able to execute on a more basic way, pretty flawlessly, not perfect always, but pretty flawlessly before we move to that. So how do we manage winners? We're going to segment based on whether DVA is rotational or DVA is imbalanced. Now, there's going to be variations on how we apply these trade management schemes depending on the strength of the narrative. Really strong narrative will give the trade more breathing room. Not as good of narrative, you know, maybe a bit of a shorter leash on that trade. Basic stuff, but we're actually going to give you some real process, just like we are for everything, for managing winners. Identifying opportunities, identifying where those opportunities are becoming valid, timing those opportunities using intraday frameworks and rhythm, a process for exiting losers, and now we're developing here a process for managing winners. Reminder, trade management can never be perfect. Anything can change at any time. So remember, DVA is rotational. We might have a weak narrative, a medium narrative, or a strong narrative. And I don't have answers for you at this moment as to if you have this, it's strong. If you have this, it's medium. That's something you kind of have to continue to develop and we can talk about. It's pretty clear where, hey, you know, I'll tell you, for example, a strong narrative is a day one breakout of a multi-day CVA where you're getting that breakout pullback. That's a really strong narrative. The recency is there. You got some duration. You know, it all makes sense, right? Taking that breakout pullback after we've left the original one and we're up here and you got something from July over here and you're saying this returned pullback, well, you know, that's fine, but that's going to be more like medium to weak. This was strong. And you guys know that. But I don't have a list for you of what is precisely weak or medium. That's something you're going to develop with your playbooks and things like that. We're not all going to take the same exact setups and trades. This is a framework that allows you to really become good at what you want within the framework. So we could have rotational. For imbalanced, it's more of a pretty standard approach because of the nature of, hey, the market's imbalanced. Let's monitor that. So we'll start with imbalanced. The stop is initially beyond the turning point. So let's say this is our DVA. And here's the trade. Just put the stop somewhere below the turn, right? No big deal. The stop can trail. Just know that, right? As this trade works, this stop can continue to move up. In general, you know, if VWAP is here, in general, again, just very generally, because we want to be able to stay in a trade that does this. We don't want that to stop us out. So just put it, around halfway to VWAP, let's say, from developing value. So technically you could turn those 0.5 lines on and kind of use them to help you with imbalanced type stop trails. But I just don't like the extra line on my chart. I like it cleaner, and it's easy to see where halfway to VWAP is. So that's just a general guideline. And we'll talk about how that might all come to an end eventually here. But we'll take an initial scale. It's just important that you can trail a stop. We'll take an initial scale on a decent rhythm in our favor. So, it doesn't have to be the top right here. It doesn't have to be before the top. A lot of people like to wait until there's a bit of a turn after a decent shift in rhythm, a decent move rhythm-wise. And then it starts to turn, take the scale. I like that. It lets you kind of maximize it. Other times, if you think it's going to be more competitive to get that scale, you could put a limit order up there. You could take it wherever. Again, taking a scale in rhythm doesn't have anything to do with the outcome and how cool that scale looks in hindsight. It just says, did we move enough for it to be considered a decent move based on the current rhythm? You should have a scale that you've taken there. So that's our scale out. Let's say we're trading 2 lots, right? 1 lot, boom, out scale with the decent rhythm. A lot of times that's going to be based on what the rhythm of this market is, that you can also kind of read with the DVA. Let's say the market, which is very common, is kind of hitting the +2. So somewhere in front of the +2 is a great place to take those scales if you're getting into any of those longs. So we're going to use rhythm plus DVA as a framework kind of for taking scales. Rhythm trumps everything else, though, in terms of scales. The core position, that's that runner, if you want to call it. I call it a core. The core position is held until a couple things happen. One, the imbalance fails. So let's draw out what that might look like, right? Imbalances don't last forever. Trading would be easy if they did. Well, we're looking for maybe the imbalance to continue, and maybe it tries to, and then it doesn't. So it's either going to push in enough to actually hit our stop, or it might push in and then have a really hard time. Maybe it's a flat bear flag type move, and you're starting to see it accept and hold back inside of our developing value area. That's probably a place where I'm just going to call the trade quits before it maybe got to where my stop was at the time. It's telling me the imbalance is failing. We will have varying degrees of tightness on saying, nope, I'm out, imbalance is failing, versus I'm going to give it some wiggle room here. Again, what's that going to depend on? Narrative. You will have some choices. You'll need to develop your processes and pick some things. Don't just like do whatever feels right, like at the beginning, like whim. But I'm not going to sit here and tell you this is perfect, this is not, this is, these are all like general framework ways of doing things, but I'm giving you some process and like bits and pieces of code that you can put together to make your full program, if you will. So the imbalance could fail on us. That's where we get out of the trade. The target could get hit, right? We could have our destination area up here and you get your target hit or close enough to it and the momentum starts to turn. Call it. Thank you, come again. Or the session could simply close if you're a pure day trader. Session's done. Imbalance was still going, but okay, well, I'm off to enjoy my life. I'm not going to sit here with overnight risk necessarily, unless you wanted to swing trade it, right? But that's a different topic for a different day. Some of you are taking this course as swing traders, so obviously some of this doesn't apply. You'll be doing this on higher time frames and expecting to hold for multiple days anyways, and that's fine, right? DVA, we're going to see as we develop throughout this course, we're going to use it on multiple time frames. It's not just intraday. We can do anything with this stuff. It's truly time frame agnostic. So for imbalance trades, the stop can trail with continued imbalance. We take a scale on a decent rhythm. A lot of times a DVA kind of rhythm-based thing can help us. Are we only getting to the 1.5 before we're turning during this imbalance? Are we getting all the way to the 2? I can kind of go for one of those two things, but it's kind of repetitive. Rhythm's going to tell you that anyways. And we hold the core position until imbalance falls apart on us, or we get the target, if we even have one, or we run out of time, if that's applicable. Rotational trade management is more complex. The stop, we put the exact same way, right? We get long here. The stop goes beyond the turning point. The stop does not move. It doesn't. It doesn't move. It doesn't matter what happens. It doesn't move. Leave the stop alone. Don't move it. Don't trail it. It doesn't make sense. This market's rotational. Rotational markets are choppier. You can't expect that you can kind of stay tight with a trailing stop somehow, or move it underneath VWAP if it holds VWAP once, or whatever harebrained idea you get. Don't trail stops during rotational DVA plays. Sometimes if I get a great trade location, and I don't think that the low of day is necessarily in, but this is a monster trade in terms of narrative, and I've gotten a really good scale out, so my theoretical price is really, really good. I might, if there was a wick down here or something, I might move my stop lower, okay? But I'm not going to move it higher. I'm not going to trail. Initial scale, same concept. Use rhythm to tell you where to scale, and based on the rhythm of this example we're drawing up here, looks like VWAP's a good place. So rhythm makes sense to kind of take a VWAP scale. If rhythm was wider, like this, well, guess what? Scale at the other side of developing value then. Don't scale VWAP. It's like, too tight. It's too soon based on rhythm. Remember, rhythm trumps everything when it comes to scales. And use DVA as a secondary kind of trade location to help with that. So now we have a couple different approaches. I might should have done those bullet points differently to make that more clear. But we have a couple different approaches we can take with essentially how we handle our core position. Sorry about that. We've taken a scale and now we're focused on the core. What's the trade really about? What's the narrative, right? It depends on the narrative. So for the strongest narratives, heck, like I said, I'm going to keep the stop all the way down here, and it can come all the way back near my stop. I don't care. I'm going to stay in this trade and my stop's going to be down here. Why would I do that? Because the narrative is so strong. Do I expect this market to just stay rotational for the rest of the day? No, I don't. I expect at some point the buyers are going to take control and we're going to get imbalanced. And even once we get imbalanced, I might not move the stop if I don't feel like it. But that's absolute loose leash. Medium leash for our core position is we got a good narrative here, okay? Keep the stop where it is. But once the market tries to go imbalanced, like we drew right up here, well, now you know what? We're shifting to imbalanced trade management. So the stop actually, for the first time, can come up here, and it can be, below the 0.5 area, halfway to VWAP, right? Something like that. Or just in general, like it just needs to work. And if we come in here and start to hold and we can't get back out, the sellers start to push it down. That's not looking good, right? We could exit. That's more of a medium leash. The tight leash, like it's a good enough narrative to put a trade on, but there's some dissonance. I'm not expecting much, but hey, we'll see. Really, it's like, there was a reason to get long up here, and then there's a reason to get out up here. And we're really just looking for the other side of DVA. We're just looking for maybe a push to an extreme where our structural reference might be or something like that. I might take a breakout pullback of prior value, but then there's a really good 2-day CVA up here, which I should start to look bearish against, even more so than the prior value I'm long against, right? And so I'm just going to target up into that general area, and I'm going to get out at the other side of DVA. It's more of kind of what I call a scalp play, but I had a narrative to it. I got an opportunity to get long. It wasn't me doing something stupid against narrative. It just wasn't necessarily with the main CVA narrative. There's plenty of risk reward on the table to take trades like that. You just have to be selective about where you do that. And you don't expect it to trend for the next 3 weeks, right? It's just a targeted kind of scalp type play. Right? I want you guys to be a great student, but ultimately, after a certain point, I want you guys to bring, your Slumdog Millionaire moment to your trading, where everything comes together that you've learned throughout your life and your trading experiences, and kind of put that, maybe, hopefully, a lot of my people that I've taught stuff to, they're not abandoning NADRO, but they are going to incorporate a few things here or there that they've learned elsewhere, and that works for them and their markets and their time frames and all that good stuff. So this is my hope for you. But for now, for this week, I want you to be unoriginal. Be a good student. That's what you're here to do. As an advanced professional trader, there's times where I tweak my stop placement. Like I said, I'll use a momentum stop. I will not stop out above the turn. This is really advanced stuff, and now is not the time for us to discuss them. Now is not the time for you to do them. Here's my phrase I say all the time. It's not my quote. First, do the simple, then do the simple better, then simply be the best at doing the simple. Have you guys been keeping up with the acronym in this NADRO course? We've got NADR. We can identify a structural narrative, there's the N, to see all this awesome risk reward and speak this language of markets. We have acceptance, the A, that's been covered fully. You can now use this concept to stay clear on your bias at any point in time during the day. Should I be looking long? Should I be looking short? Given that there's a reason to do anything, right? Acceptance has to have a good reference in order for us to use the concept of acceptance. It doesn't just exist in open space. In a D, DVA, developing value area, once we have some kind of a trade idea from narrative, and once we have acceptance that says, okay, we've accepted below the level, now you can look short, well, DVA. If we're looking short, we could fade an upper extreme of DVA, or we could go with an imbalance down in DVA. And then rhythm helps with a lot of stuff, but ultimately the reason why, rhythm's a component of acceptance. So why isn't it listed first in the acronym or whatever? Like, I get that question all the time. It's because rhythm, once I've got a narrative, once I've got the acceptance picture, once I've got a trade location in terms of DVA, I'm pretty focused on rhythm, a turning point. So that's why it is there. This is chronological in terms of a top-down approach. All right. See, I told you it wasn't going to be 3 hours. It's only been 2.5. Yeah, Nardo doesn't have a good sound to it either. NADRO, it's much classier. The things we're going to be doing this week, we're going to be building from mental framework. I want you continuing to put focus there. We're going to be building from market framework. You're not masters at hypos yet, guys, right? continue to work on building your CVAs and all this stuff as we get more reps in. Now we're going to monitor the acceptance picture as the official type term, right? Noting where it changes, where conditions change. We're going to monitor general rhythm, and then we're going to be in rhythm using general rhythm. So what are we going to do this week? You're going to prep mentally. Not just prepping your charts. Remember to do some affirmations, visualizations. Think about working on your mental game before the market opens. So that's request number 1. Then I want you to develop your hypos, just like we did last week. Nothing's going to change there. You should just be getting better at it. Keep sharing those with each other in the room. Talk about the differences you have and Johnny Appleseed has and Sally, what's her name, has. Talk about the differences you have in in narratives, hypos. That will be very enlightening. Then take trades. No more dummy system. Dummy system's gone. You can use Heikin Ashi by all means. Just use it as a way to see those short-term shifts in momentum if you like. But take trades using the following checklist. 1, narrative has to be there. Is it a breakout pullback? Check the box. Or is it a return pullback? Check the box. And then you might check one of those and continuation, right? It could be a breakout pullback, but it's a continuation from an existing, already established breakout pullback. Acceptance. As I'm stalking the trade, you should be filling this out, right? As you get the idea, so you could fill these out. This is a pre-trade checklist. The only thing is the very last check mark on rhythm you might fill out right after you enter, right? It's fine. Narrative is there. Okay, breakout pullback. All right, it's setting up because of the acceptance picture. And I'm saying that the breakout pullback is there because of distance acceptance. We've pushed far enough beyond the level. Check, check. DVA. Okay, I still don't have anything with DVA, so let's see. We are rotational, so I'm going to be looking for an extreme fade. You could go ahead and check it. Doesn't matter. And so now when you are at the lower extreme of DVA, if you're looking for a long trade, get yourself enough of a counter rotation. It's no longer a 4-bar pullback. Probably going to be more stringent, right? And it's not just about 4 bars in a row. It's about the distance of the entire rotation, no matter how many up or down bars were there. Enough of a counter rotation. And remember, there's 2 things to be in rhythm for a trade. You get a counter rotation, and you also would need to check that your entry was early in the momentum shift, right? Not late once the Heikin Ashi had already turned and we're drifting far away from there. Not early after we've had an up rotation and then you get this and you're getting long. That doesn't make sense. That's early. Wait for enough of a counter rotation and then get in with a momentum shift. So both of those things. So I might take a breakout pullback continuation play with time acceptance where I got an imbalanced pullback and I had enough of a rhythm and enough of a momentum shift. And that would look like breakout pullback, but it's already occurred and our DVA is here and I took this trade. Enough of a counter rotation and a momentum shift where I pulled the trigger. If you're going to lean on Heikin Ashi for your momentum shift turning points, this is a continuation play because it's not from the reference. and we haven't hit a destination. It's in open space between the areas. If you're going to lean on Heikinashi for your trigger, which I, quite frankly, right now at this level of development, I suggest all of you do. It doesn't mean you take every Heikinashi color change. No, you use rhythm. And then once rhythm is there and you get a Heikinashi shift, that's your momentum shift. That's the second part that you need. If you're going to do that, I recommend you absolutely wait until the bar closes. Ultimately, you'll learn which bars are really at risk. You'll see them kind of flash blue, then white, then blue, then white. Like you don't know which way that's going to close, right? But some that really take off after the prior bar was a wick and it like miraculously didn't change color, you don't have much of a risk that that's going to change back to the non-signal color. So yeah, definitely wait for them to close at first and then build an expertise from there. All right, guys. So, you don't have all the answers right now. You probably have some questions, but the way that I've designed this week is to really teach you all the theory, all the process that you can begin to put together. And then we're going to get a whole lot more real examples throughout the week. You're going to, get nightly reports showing trades that make sense with this checklist. And it's going to be a beautiful week. This is really where the rubber starts to hit the road with NADRO in a big way. And so you're going to make mistakes. You're going to overlook things. You're going to overweight something and forget something else. You're in a learning process right now. Embrace that. Motivate, keep forgiving yourself for your silly mistakes. You should see the trading that I did when I first started trying to put all this crap together. It was terrible, right? I've got screenshots and videos to prove it. I've shared them with many people in the past. So it takes time, but this is a great program to get a bunch of reps in and get oversight on here's what you could have seen or should have seen today based on these principles. So hope that's been helpful. Have a great week. Enjoy Nader. Cheers.